Hello Sector Watchers, welcome to the show. This is the 120th episode of Sector Spotlight for Tuesday the 29th of March. I'm recording it on Monday the 28th. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. We have to catch up 2 weeks because I had to cancel last week's show. Finally, after 2 years of dodging bullets and COVID infections, etc., I was caught by the virus, and I have to say I'm still not 100%. It's not great. It's no joke either. So we're gonna try. I will do my best. I've been laying low last week. I really wasn't not feeling well on Monday last week. I tested positive on self-test on Sunday and then a PCR test on Monday, and I was really bad on Monday and Tuesday. Caught up a little bit, did Your Daily 5, did a money show with Dave Keller, but other than that, did not do much. I was just feverish, headache, cold, all around miserable, let's call it like that. So let's see what's happening today. Anyway, last Tuesday of the month, so that means that we have to deal with seasonal patterns. So we're going to take a look at that. I'm going to try to catch you up on 2 weeks of rotations on asset classes and sectors. And obviously a lot has happened. Always when you're not there, everything starts to move. It's a bit of a pity, but that's what it is. And if time permits, maybe we dive into some individual names on the individual sectors following some of the seasonal stuff that I want to discuss. So without further ado, this is Sector Spotlight. Let's get started. Let's start with the rotation of asset classes. On the right hand side we have the daily RRG showing the asset class ETFs that we track, and on the left hand side you see the weekly RRG of those asset classes. We quickly start on the right hand side, that's last week, and then if we browse back another 5 days, so 1, 2, 3, 4, 5, that's the week before. Then you can see that basically over the last 10 days the stock market did really well. It started to pick up 2 weeks ago, and it actually continued that rotation into the leading quadrant last week, which shows the strength of the stock market as we've seen it, and obviously the weakness of the fixed income related asset classes, corporate bonds, high yield, government bonds, and then also real estate, and the dollar actually retreated a little bit over the last 5 to 10 trading days. Commodities went through a very long rotation leading and then into weakening, and they're now starting to pick up slightly inside the weakening quadrant, but they're still moving left on the RS ratio scale, so they're still losing in terms of relative strength. If we move over to the left hand side where we have the weekly RRG, then you can see that that's a very relative understanding for commodities, because here the two tails of DJP and GSG are still way up into the leading quadrant, into the top right, basically distorting this asset allocation RRG because of the length of their tails and the disconnect from the rest of the universe. So I'm gonna take those off here and recenter the image to get a better handle of what's going on with the other asset classes, because we do know that commodities are doing really well. And then we see that the strength of the dollar, the long-term strength of the dollar, is still there. You can see that tail here nicely moving higher. Last week and a half, last 2 weeks, this is only today. Last 2 weeks leveling off slightly. That's caused by this weak rotation on the daily chart here. And then we see that government bonds and high yield are inside leading and rolling over. Corporate bonds never made it into the leading quadrant. They're rolling over right here. And you see that V&Q and SPY stock market are inside weakening. And It's a bit tricky now because when I put it here, this is last Friday, and this is only, so basically this is only 1 day of trading on this RRG. Just to be very correct, this is last week, this is the weekly RRG, this is last week. Everything else until Friday will be causing differences in the position of these last observations. We see a slight improvement of SPY right now here. So this could be a rotation of stocks inside weakening back up to leading. But it's pretty early to make that call. There are many other reasons why I am still cautious about the rotation of the stock market and the behavior of the stock market. I'll hope that we can talk about that a little bit later in the show. But for the time being, definitely stocks are doing well. They bounced higher than I had expected, fair is fair. And we'll have a look at that chart later on and try to dissect, try to analyze where that came from. For the time being, I think that the rotations are definitely still mixed. Strongest, clearest rotations still for commodities and the US dollar. The rotation for stocks versus fixed income, as I said, is mixed. Short term seems to be in favor of stocks. On the daily, that's definitely the case. And we'll have a look at some other charts to see if we can get a better handle on what's going on there. As I said, the chart of the US dollar is continuing to strengthen. If you look at the chart of euro dollar, then you can see that we're still trading in that long-term falling channel. That's in play now. It's almost a year now. And we had a couple of wild swings 2-3 weeks ago, but it looks as if we've established the break below 111, tested it a few times, and we're now in the middle of that falling channel, and it looks as if we're continuing to move lower. So for the time being, I'm maintaining the position that the US dollar is strengthening versus the euro and most other currencies. Another interesting chart that I want to bring up when this image is so messy is the chart of the benchmark, actually. It's the chart of VBINX. So this fund, the Balanced Index Fund, represents a balanced portfolio which consists of 60% allocation to stocks and 40% allocation to fixed income, various fixed income asset classes. And if you look at this chart, I think you'll agree that that's a pretty negative chart. We left that uptrend, we completed this double top here, pretty well respecting former levels of support and resistance. And we did break below an important resistance level a couple of weeks ago, and we're now testing it from below. So we're now testing that old support level as resistance. And for the time being, we have not been able to break higher. So the market, the capital markets, if you wish, consisting of stocks and bond markets, are not in the best of shapes. And despite the fact that we did see that rally in stocks, I'd still be very, very cautious with very new and unprotected long positions. And I think that the biggest warning signal, the most important warnings and red flags are coming from the bond market. This is IEF. This is the 7 to 10 year bonds in the US, Treasury bonds. And this, we've noticed, we annotated that super large head and shoulders formation and the break. And this chart is, I've got this chart up, I think already 2 months, maybe 3 months. And we labeled that target here around 103 based on that head and shoulders pattern. And we're actually very rapidly approaching that 103 level in IEF. And usually those rising rates, because a falling price in IEF means rising rates, is not the best support for a rise in stocks. If we move to the yields, to the yield that belongs to that 10-year US Treasury, then you can see that we pegged it at 3% based on the reverse head and shoulder, which is basically reversing the IEF chart. And you can see how rapidly we're jumping here with big gaps, moving towards that 3% target. And that's one of the things that I keep in the back of my mind as something that worries me. Those rapidly rising interest rates is not a very good thing. Investors generally don't really like very rapidly rising yields. I mean, I do understand that you know, higher yields were sort of inevitable, and in a way they're good, but this is going really, really fast, and I'm wondering whether, or I'm asking myself, how long will the market tolerate this rapid rise in interest rates? If we go to the chart of SPY, then obviously we had that little bounce there up. This is the weekly chart. This is the long-term chart, and you know, even just by looking at this chart, I'm still not very happy with it. I mean, we broke that downtrend. We're not trading near all-time highs. We're actually in an area with a lot of overhead resistance, and I just want to wait and see how that plays out. And I mean, I have a very hard time believing that this has been the bottom and that we're now going up in one straight leg higher, because rallies or trends consist of higher highs and higher lows, or lower highs and lower lows. Well, I mean, this is a 3-week trend now, and compared to, you know, this 2.5-year move, it's not really much yet. And my problem is that for the time being, there's no other way that I can see it as a little bounce back in a series of lower highs and lower lows. I mean, the last series high here is around 456, so that's an important level to watch. But for the time being, this series of lower highs and lower lows is still there. So I'm gonna label this as a counter trend move still. If we take out 456, then this downtrend is a goner, it's out. Does that mean that a new uptrend has started? No, not at all, because we don't have higher highs and higher lows yet. So, you know, the best scenario that I can come up with is that we start moving sideways, and that we will see some sort of a response to the 3-week rally that we've seen. If we look in a little bit more detail on the daily chart, and this is the image that we're looking at, and the last time that we spoke, we were just trading around here. I remember that very well because we discussed the positive divergence, and I explained that we needed, or I would like to see some sort of a confirmation to validate that positive divergence. And at the time that I recorded that video, that just wasn't there. And I think I labeled the 430, the break out of that falling channel here, as the confirmation of that positive divergence. And obviously that happened like a day or two later when we took out that falling trend line and we started to move higher. So around 430 was my confirmation that that positive divergence was actually working. Did I expect that to happen? No, not really. Do we act on it? Yes, of course, because that's what markets do. They give us a clue, they give us a signal, they give us a confirmation. So any short positions, I'm not trading on that level, but would have been killed around 430 when we had the confirmation of that positive divergence in play. So what am I watching right now? Again, the 456, 457 area, definitely an important area. As you can see here, even this move here, the last 2 weeks, has not really shown you any higher highs, higher lows. It's almost one straight line higher, and that makes it a risky move, at least in my opinion. So stocks are doing well. Yes, they are. I believe that it is still a counter trend move, and if you look at the daily chart here, you will see that there is a lot of overhead resistance levels that still need to be overcome. Do you need to be in a hurry to get back into the stock market? I don't think so. Finally, the commodity charts. Here is DJP, and you can see that obviously they are in very nice trends, and they've reversed that very long-term weakness that we saw many years, but now we're running into some sort of resistance. So here you see there's a high of 2014 is now coming into play, and with those very steep rallies, I wouldn't be surprised if we got to see a little bit more of a correction in in commodities, it's not gonna make it a negative asset class. I think we will get better entry levels later on. I mean, it's not a problem if we see some form of a decline in commodities, both on a price level as well as on a relative level. So that's it for the asset classes. We're now going to take a quick look at the sector rotation. When we move to the rotation for sectors, then on the right hand side the daily RRG, left hand side the weekly for the 11 S&P sectors. And we start on the right hand side with the daily rotation, and this includes today, this includes Monday's price action. So if we go back to Friday, then this is where we were last Friday when the market closed. And the interesting thing is that there is none inside the leading quadrant and only one inside the lagging quadrant. And you can see this big group inside weakening. They're all moving at a negative heading southwest, and we've got this group here inside improving, and they're moving northeast at a positive heading. This is typical behavior for a transition, because when you're on the right hand side, preferably inside the leading quadrant and like stable, that is an established relative uptrend. On the left hand side, that's an established relative downtrend. And what you see here is that the groups are moving. So you see this big group inside weakening, they are rotating out of favor, and you can see that group here with discretionary, financials, tech, communication services, they're rotating into favor. So this is a short-term rotation from one group of sectors to another group of sectors. Now we do need to put that into a bigger perspective to make sense of all of that. And if we go back to the rotation that we saw in asset classes, we saw that rotation, that short-term rotation into stocks and the short-term rotation out of fixed income. And then we see that a little bit more in detail here on this RRG, where we can see the more cyclical sectors like tech and discretionary and the more sensitive stuff like financials getting into favor, and defense like utilities, healthcare, and here is even staples out of favor. Now if we bring that to the longer term picture here on the left hand side where we have the weekly RRG, then obviously still the XLE, the energy tail, still way up inside the leading quadrant, rolling over. So here is the daily tail for XLE that's causing that decline here, that vertical move, that momentum decline. So I'm gonna take this out of the equation so we can get a better handle of the rotation of the other sectors. And then you can see that, and you remember that I've been talking about the markets being pulled higher by defensive sectors, and that's the staples, utilities and healthcare sectors. And that story, despite the fact that they're rolling over, that's kind of still the case. If we look at the rotation here on the daily, then you can see that utilities is still way up there, and then staples is below, and healthcare had a very weak week. But if you look at the rotations from a longer term perspective, then these sectors are still doing very well. So here's healthcare, here is utilities, and staples is actually lagging the whole pack. And you can see that that is actually the sector that is has the weakest tail in terms of momentum. However, it's still a pretty high reading on the RS ratio scale. So it went through a correction, and it means that staples is still in a relative uptrend versus the S&P 500. And don't be fooled by this minus 0.3 over the last 5 weeks, because that's over this period. That's still a corrective period. It's still on the right hand side, so the trend is still actually pretty good. What we see here is that technology and discretionary are turning upwards. They're picking up a little bit of relative trend, but they're inside the lagging quadrant. Given the story that I told you about the rotation and the mixed picture on asset class level, I think this underscores that actually. So we have the defensive sector still inside leading. We have discretionary, a very clearly cyclical sector, and technology, which is now like the sensitive stuff, in the left-hand side, inside the lagging quadrant, and we still have communication services rolling over here back into the lagging quadrant. Makes it still a mixed bag, and underscores my belief, supports my belief that the market is still a risky place. I'm not 100% convinced that stocks are the best place to be at the moment. Let's have a quick look at the individual charts. So here is technology, and you can see this chart is still, at least in my mind, fairly negative. We're bouncing, so we're running into the next resistance area here. We drop back below the breakout level in terms of relative strength. And if you look at the more defensive sectors, then you can see that staples, which is right here, is now actually coming out of this consolidation and seems to be starting a new move higher inside the uptrend. And that is supported by potentially old resistance becoming support in terms of relative strength, which would make the staples sector again an interesting sector. If you look at healthcare, then it's bouncing back on the way to its all-time highs levels, and you can see that it's holding up above the breakout in terms of relative strength. And if we look at utilities, that's probably the strongest defensive sector at the moment. It's breaking to new all-time highs. Utility sector breaking to new all-time highs with relative strength curling back up. I don't think that I've ever seen a strong bull market while the utility sector is pushing to new all-time highs and picking up relative strength. Now let's wrap up the show with a quick look at the seasonality going into April and beyond. And if you look at the column of percentage of months that a particular sector is outperforming the S&P 500, you see that there's actually only two meaningful numbers here, and that's 71% for communication services and 70% for consumer discretionary. All the other numbers, 50, 55, 40, they're not meaningful enough to be included in any form of seasonal analysis, in my view. If you look at communication services, that's interesting because you see 71% in April, 79% in May, and then it drops to 57 in June. But by the looks of it, communication services historically is going into a strong period or into a period of strong performance. If you look at consumer discretionary, that seems to be a hiccup. April seems to be particularly strong with 70% of time in outperformance, and then it drops again to 55 and 45. If you look at the performance numbers, the actual performance numbers that belong to these numbers, we see that communication services historically have averaged 0.9 and 1.2% outperformance over SPY in April and May, and consumer discretionary actually historically has outperformed the S&P 500 by 1.2% in April. So with these two sectors, communication services and consumer discretionary, with high odds of outperforming the S&P 500 and relatively high levels of outperformance, that means, and if you look at the current state of rotation, then you can see that consumer discretionary is right here and it's picking up a little bit, and you see that communication services is still way down inside the lagging quadrant. So these are sectors that are clearly in relative downtrends. Discretionary is picking up a little bit, and communication services is very stable. Now, if you looked at the performance numbers, you can see this pretty much fits into the story where there is a bit of a hiccup inside the decline. So you see discretionary and communication services, I can see those bouncing higher in the coming month. So it's a bit against the odds, and I'd still be urging a lot of caution. But based on seasonality, we can expect consumer discretionary and communication services to actually have a pretty good streak. But I think it will be within a longer term downtrend, within longer term weakness. That would also fit with the numbers that we can expect from the defensive sectors, where you can see that healthcare, utilities and staples are, based on their performance numbers, expected to have a weak period. And that coincides with the rolling over of the tails inside the leading quadrant. They're still good, but they're rolling over. And that seems to be fitting in with that seasonal picture that we're painting here in this 3D visualization of relative strength and relative performance. And that concludes Sector Spotlight for this week. I hope you enjoyed the show. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope to see you again next week, same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.